a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi, everyone. Welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about free cash flow ETFs. And these ETFs have seen a lot of interest. One particular has seen a lot of interest from investors this year. And so let's talk about free cash flow and why it is so important. So, according to Warren Buffett, our best investor, the greatest investor of our time, he says that free cash flow, which is the cash remaining after a company has covered expenses, interest, taxes, and long term investment, that is the most crucial valuation metric. And he favors companies that generate more cash than necessary for their operational needs. Now, let's talk about value stocks and why, while selecting value stocks, you should focus on free cash flow. So, traditional value investing that relied on mainly on price to book ratio. So, cheap value companies were identified by low price to book ratios, and this metric was outlined by Nobel Prize winning economists Eugene Fama and Kenneth French. Now, this approach worked well earlier in a manufacturing based economy where balance sheets were asset heavy. Now, that has changed, and there's an interesting study by Lord Abbott, which is an investment manager, and they say that this approach worked well when companies' assets were mainly physical. And now that has changed. Earlier, companies had a lot of factories, inventories, real estate. Now, balance sheets have changed, and intangible assets like and intellectual property, software, brand value, they now make up about 80% of assets in the S&P 500 companies, which makes price to book less relevant. So this is the chart where Lord Abbott shows the evolution of companies and how the proportion of companies' tangible assets has shrunk. Percentage of intangible assets has continued to rise, and now it is more than 80%, 85% in the S&P 500 companies. So because price to book is less relevant, they looked at the performance and they saw that between 2000 and June 2024, a portfolio based on value factor alone, value factor determined by price to book, a portfolio that returned 519%, whereas a portfolio which relied on free cash flow yield that returned more than double. So that is why many investors like to look at free cash flow and free cash flow yield now, and they consider free cash flow as a better indicator of financial health. Now, quickly, how free cash flow is calculated. So, it is basically cash flow from operations, and you subtract all expenditure, including expenses, interest, taxes, long term investments. And then you look at enterprise value, which is market cap plus debt minus cash and cash equivalent. And then you arrive at the free cash flow yield, which is a free cash flow divided by enterprise value. Now let's take a look at ETFs that focus on free cash flow. So the pioneer in this space is Pacer. So the Pacer US Cash Cows ETF cows. This has about 21 billion in assets now, and this selects 100 companies from the Russell 1000 index with highest free cash flow yield, and then weights them by free cash flow. Let's take a look at this ETF by going to the quote page on Zacks.com. You can read our research report articles. I also did a podcast sometime back with the provider. Now, using the link, you can go to Cow's webpage and it shows you how they select companies for inclusion in this index. So, as I mentioned, they start with the Russell 1000 and then they apply these free cash flow yield screens and select 100 companies with the highest trailing 12-month free cash flow. And the portfolio that they arrive at is about 20% in healthcare, then 19% in energy, then information technology and consumer discretionary. The top holdings are Ford, ExxonMobil, Chevron, Pfizer, etc. Now, the second ETF that I want to highlight has seen significant interest and inflows this year. It has gathered more than 2.6 billion in assets year to date and now has 4.4 billion in assets. And it's because it has done much better than cows. And the difference, we will see what the difference is between the two ETFs. So this looks at strong free cash flow yields and high growth metrics as well. And then it considers a forward-looking measure of free cash flow. It has an expense ratio of 39 basis points. So again, to learn more about this ETF, you can go to the quote page on Zacks.com. And from there, you can go to the VictoryShares webpage. So as I mentioned, it looks at not only the trailing free cash flow, but also the forward free cash flow. And then it arrives at the expected free cash flow, and that is used to calculate the free cash flow yield. So because of its focus on growth, it has done better than cows, and the portfolio that it arrives at is, you see Qualcomm is the top holding, and then you see Merck, Cigna, United Health, Expedia, etc. Looking at the sector exposure, consumer discretionary is the top sector in this ETF, and then you have energy, healthcare, and industrials. Now, the third ETF that I'm highlighting is also growth oriented, and I am including this in my analysis because this is the best performer. Obviously, Invesco NASDAQ Free Cash Flow Achievers ETF, the ticker symbol is QOWZ. And because of its focus on technology companies, we know that NASDAQ is a tech-heavy index. This has done the best among the group. This looks at positive free cash flow in each of the trailing 11 years and year-over-year growth. This is much smaller, much newer, 15 million in assets. And again, if you want to learn more, you can go to the webpage for this ETF and the US listed, NASDAQ listed companies with continuous and stable growth in free cash flow. If you look at the holdings, NVIDIA, Meta, Broadcom, MasterCard, these are the top holdings in this particular ETF. Now, in addition to these ETFs, some other newer ETFs are also worth a look. These all ETFs, including the Invesco ETF, they all made their debut in 2023. The other three are quite much smaller. The Amplify ETF focuses on cash flow and dividend growth. The ticker symbol is COWS, COWS. And this has about, I think, 22 million in assets. Then there's one by GlobalX, US Cash Flow Kings ETF. The ticker symbol is FLOW. And this has about 12 million in assets. And there's one by Themes. It is the Themes US Cash Cow Champions ETF. The ticker symbol is LGCF. This has about 2 million in assets. So slightly different methodologies and slightly different portfolios, but I included all of them in my performance analysis on this page. So I have the comparative performance over the past 1 year compared to the S&P 500 index. So as I mentioned, the Invesco product has done the best, obviously because of its focus on technology stocks, which continue to do so well. So this has returned about 19% over the past 1 year. The Victory Shares ETF, VFLO, and the S&P 500 index, they have returned about 17%. And then you have other ETFs, cows, in fact, the Pacer products, COWZ, that had the worst performance over the past 1 year. Now, on the second slide, I have taken slightly longer term performance, and this is since the inception of most of these newer products, which made their debut in 2023. So this looks at the performance from December 2023 till date. And here also you will see that Invesco product has done the best. And then the S&P 500 index and all other ETFs, they have underperformed the S&P 500 index, but they have done much better than value indexes. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. Make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.